Hello and welcome to Virtual Investor Conferences. My name is Eric May, and on behalf of OTC Markets, we're very pleased you have joined us for our next live presentation from GBank Financials Holdings. Before I introduce our speakers, a few points to note. Please submit your questions in the question box to the left of the slides. If you are interested in scheduling a meeting with GBank Financial, please click on the Meetings tab found in the left navigation bar. You'll be able to view the company's availability and submit a meeting request. On a final note, all of today's presentations will be recorded and available for 24/7 replay. At this point, I am very pleased to welcome Ed Nigro, Chief Executive Chairman, and Ryan Sullivan, President and CEO of GBank Financial Holdings, which trades on the OTCQX specs market under the symbol GBFH. Welcome, Ed and Ryan.
Well, thank you very much, and it's a pleasure to be on this virtual conference this morning. I think that the timing is rather interesting given all of the recent activity in banking and a couple of very significant bank failures that have all of a sudden brought banking to very much a forefront on everyone's mind. And since there is a great deal of information and some information not correct given out there, we thought we would focus a little bit on GBank and what makes us, I think, a very important, significant, strong bank. And I think there are many strong banks out there, in spite of what we may be reading in the newspapers. So I wanted to start. We have a deck that we are going to make available to you on our website afterwards, and we're going to jump around a bit on that deck. But the first thing I wanted to introduce was a letter to our shareholders that we wrote last week. And this letter was sent out because, as all banks were, people called us saying, "Ed, are you okay?" Or, "Ryan, is the bank okay?" And we would say, absolutely nothing's changed since the week before. As a matter of fact, we continue and remain to be very strong. Our stock was not impacted. Our deposits have not been impacted. And we put this letter out because there is a concentration right now on things such as liquidity, earnings, but not so much earnings as deposits. And how safe are deposits? And there's been a lot of focus on uninsured deposits and what that means. And we have tried to explain, and I think it is true of most banks, that uninsured deposits are not something to fear. As a matter of fact, it's how those deposits are used and how your bank functions and how your bank really exists in the world of its liquidity and its earnings and its ratings on its loans. And when we covered this, we started to talk about our liquidity and how strong we are. Because when we formed this bank, our strength started at the very beginning. We did it with 180 shareholders and said no one individual could own more than 10% of the stock. We also had our individual shareholders open business accounts with us. If they couldn't, we didn't sell them shares. We wanted people who were doing business with a business bank, would deposit our bank, would borrow from our bank, and would be part of our bank going forward. So from very day one, we had 180 shareholders. And actually, to even today, 47% of our bank is owned by our respective boards. And we have about another 17% owned by institutional investors. And then all our individual investors make up the rest. Retail investors such as you, but mostly our clients are our shareholders. They're our depositors. And so we have a great deal of strength in our deposits because these companies have grown with us over the years and have remained our stalwarts. We're in many different businesses. We're a business bank. We lend to many different businesses, everything from real estate, construction, finance, attorneys, medical, you name it, we probably have loans to that industry. So we're not dependent on one. And then we also developed fee income, which is a very important balance to our interest income. And as you'll see in the rising interest rate environment, some banks are what we call asset sensitive, and meaning that when interest rates go up, our revenues, our net interest margins go up. Of course, you have to look on the other side on your investment portfolio, because we have seen a lot of noise about investment portfolios and how some banks have invested in very long-term investments thought to be really secure, like US Treasuries. But in a rapid moving environment of interest rates, the value of those bonds decline as the interest rates go up. So you have to watch how the mark-to-marketing of those go, or how they are held, and if indeed they are very long-term. As we say in our letter, our duration is very short. Ryan and I went through the Great Recession together back in 9, 10, 11. There's one thing that people forget sometimes. There were almost 1,000 banks that failed then. No deposits that I can recall were ever lost, because deposits are cash in a bank, funds in a bank that have been converted, some to loans, some to investments, but deposits are real, and they're one of the most valuable parts of a bank. So when a bank does fail, the deposits are generally moved to another bank. There is going to be a lot of noise about what's happening in some of the banks, and you'll hear a lot of noise about uninsured deposits as well. But uninsured deposits are our strength. One of the important things that we do, if you look at our non-interest bearing deposits, what is that? Those are deposits for which we pay zero interest on. They run over 55% of our deposits. Why is that important? Because these are the business accounts of all of our myriad thousands and thousands of businesses we bank. And those, when we give a loan and those deposits come to our bank, we get the revenue from those businesses. We actually have a requirement the businesses we loan to make money. That's an interesting requirement, isn't it? But they have to meet certain debt coverage ratios that we insist upon. So we know that our borrowers, we know their financial strength, we know the stickiness of those non-interest bearing deposits. So I've tried to cover a few of the general topics that are going on today, because we wanted our shareholders, and we wanted to remind them of the kinds of strengths that we have as a business bank, where we have fee income, we have net interest income, and we have a very, very stable deposit balance sheet. Now, I've given a little bit of an introduction and hit some of the broad brushes, but we have an interesting deck. And one of the things I don't want to overlook are our board members. We have a remarkable board. They head up key committees. Our holding company board has some extraordinarily prominent individuals on there that could be on any bank of any size or any financial holding company. They have public companies. They have had and do have one of our board members has 70,000 employees. So we get the big picture and we get the small picture. And we're a bank that deals with businesses and deals with our business partners. And I'm going to let Ryan now take dig a little deeper into some of the detail for you, and then we're going to take some questions. Thank you. And Ryan Sullivan.
Yeah, thank you, Ed. We're going to jump around a little bit, but just to give a little bit of a highlight in terms of the company and bank, GBank. We are a very high performing bank and really focus on the basics of liquidity, capital, asset quality. You can see our results over now the last 7 years have generated metrics and safety characteristics that rank us in the top 10% of all of our peers by size, and going all the way up to 3 billion. You'll note that for each of the last 6 years through 2021, and now including 2022, it hasn't been announced yet, we've been performing at the top 100 community bank level as designated by Standard & Poor's. You can see that we have very strong asset growth, we have strong asset quality, very high capitalization rates that have supported our 30% compounded annual growth rate over the past 6 and 7 years. Liquidity, which we'll touch on a little bit more in a moment. and obviously profitability with consolidated ROA in 2022 of 1.7%. So there are a few slides that 4 weeks ago, honestly, didn't garner a lot of interest that we'll spend a little bit of time on today. Specifically, one of the things that was always important for us, as Ed alluded to, even through the Great Recession, the bank opened in September of 2007, was our key balance sheet discipline and liquidity strategies. We believe and believed through all the way through 2022, 23, and beyond that our core deposit funding strategies really are the long-term key to our success. Ed alluded to our very high level of non-interest bearing deposits. Through the history of the organization, we've ranged between 40 and 55% non-interest bearing. In fact, in 2022, our deposit growth was centered almost exclusively in non-interest bearing deposits, where we grew that particular line item by 70 million. And ended the year at the 55% that Ed alluded to. There's also, as Ed mentioned, a lot of conversation in the last couple of weeks about uninsured deposits. That's part of the conversation. The follow-up question is what is the composition of those uninsured deposits? We work very closely with our stakeholders, our insiders, directors, shareholders, our gaming fintech partners. And you can see that we have, within our top 20 deposit relationships, they comprise 40% of total deposits. To get even more granular, our top 5% actually comprise 20% of total deposits. Our top 3 deposit relationships are corporate accounts that we have that are insiders directed by directors of the bank and bank holding companies. So these are very stable deposits. And at a time in recent history over the past 2 weeks, where a lot of our regional, local, peer, much larger institutions have been reporting outflows, we're actually up year to date in deposits. And we're very encouraged, even in the current backdrop and current environment, that we'll be able to execute on our deposit growth strategies in 2023 and beyond. Another key point that's been discussed is our asset sensitivity, our balance sheet management, and specifically our investment portfolio. You'll note if you looked at our balance sheet that we currently have an investment portfolio of approximately 107 million at year end. Of that, nearly 105 million is in the HTM category. So we have a very, very low AOCA mark, approximately $200,000 in that HTM portfolio, which is about 105 million of the 107 million investment portfolio in total. It's really comprised with 2 categories: short-term treasuries of 2 years or less, some of which are actually at a gain today. That comprises 62%, and then 31% of our HTM portfolio are variable rate Ginnie Mae securities. So we feel very comfortable in our overall balance sheet management, including our investment and securities portfolio. Now, one of the things that we realized through 2020 and 21 is that rates probably only had one direction that they could likely go. And in fact, we're seeing that in the last several quarters, and including the potential Fed decision that's happening right now. One of the things that's important to highlight, as Ed talked about asset sensitivity, is we have maintained very strong discipline in our overall balance sheet management. During the course of 2020 and 21, we held as high as 1/3 of our balance sheet in cash and cash equivalents. We still maintain that base today, as indicated on the letter, greater than $120 million in cash. We also have a very high level of variable rate loans within the portfolio, in addition to the variable rate securities that we mentioned. So if you combine those 3 variable asset rate variable assets together, we have nearly 2/3 of our asset base are variable, and we've seen that in our margin expansion. So notably, if you compare Q1 of 2020 or Q4 of 2021 to Q4 of 2022, we saw a consolidated net interest margin of 356 at the final quarter for 2021 expand all the way to 5.29%. In other words, over the course of the year, we saw margin expansion of 173 basis points, which really ties into the strength of our earnings stream. SBA, as you can see in the slides and looking at our financial performance, has generated significant gain on sale revenue. And as gain on sale revenue has gone down, as the markets have changed, we've augmented that and actually reported record net revenues in 2022 with a much larger composition coming from our net interest margin, really fueled from our key strengths in liquidity and our core deposits. So with that, I can touch a little bit and just quickly, as we mentioned on SBA, we are a top 14. We're actually ranked 14th in the country for SBA lending. It is indicated in the letter. You may note that we actually originated approximately 50 million in SBA loans for the first 2 months of the quarter. So we continue to see very strong pipelines there. One of the things that's been great for us as it pertains to asset quality is we are a significant national hotel motel lender within the government guaranteed space. We really like the metrics of that. LTVs of approximately 70%, strong debt service coverage ratios, as Ed alluded to. Good cap rates, average close to 9%, and that portfolio has and continues to perform very well in the current time frame. Another key component for us that we wanted to make sure we had some time to cover is in terms of our growth strategy and some of our important business lines would be gaming fintech, and we certainly wanted to spend a moment on that. And with that, I'll let Ed take over for just a moment.
One of the important aspects of us, when Ryan and we were talking about historical in terms of why we wanted to build a foundation of strength, is deposits. And even when deposits, there was so much money in circulation that came in circulation the last 2 or 3 years, especially by all of the quantitative easing. But we knew deposits would ultimately be, and they are, the lifeblood of any bank. And they would become important again, as they are today. So we saw, I was in gaming for 17 years of my life. And the state of Nevada is an important gaming state, obviously. And we found a way in which to bank our gaming companies. In 2014, a company called Sightline got a money transfer license and a money service provider license in the state of Nevada. They came out with a bold statement. They want to start to make gaming cashless. Well, recognizing, I think, the importance of this and the ultimate event of it happening, just think of it. Commercial used to be all cash. And today, almost 90% of all your purchasing is done with some sort of payments mechanism, mostly credit cards, still over 80%. But think of cashless gaming as you've seen in the sports world, because sports betting was the easiest one to convert or to start to convert to a mobile app, to an app like MGM. And we started with Sightline and signed a long-term contract, which we just renewed for another 10 years, to develop and issue their prepaid card, which was embedded in in many gaming apps. Those are some of the customers you see across the bottom. We started with MGM. And we started before PASPA even came into effect. That was when sports betting was allowed to go across the country. And what we are doing is that for these consumer accounts that are loaded on all of these apps, their money is actually held at Bank of George, or now GBank. And so we found a way to participate in cashless gaming. And then we developed what's called a pool player account with our sister company, Bank Card Services. GBank has a long-term contract with Bank Card Services, which was created back in 2015 because there was a substantial investment to get into this space, into this payment space. Well, now we have a pool player account, which actually takes the money from the gaming company's balance sheet, all these consumer funds, and puts it in the bank in insured individual accounts for the player. This will be true of not only gaming companies, but all companies that hold significant player assets or customer assets. where we actually settle the accounts in the bank, and the casino never touches, or the gaming operator that has a PPA never touches the cash. They're the digital representation of the cash, and the cash is placed in the bank. At the end of the day, after all the wagers are said and done, the bank distributes the funds where they're supposed to go. So the funds are all transmitted, if you will, internally. And this is a unique breakthrough which BCS has patented, and in which GBank has a very long-term contract for. So having said that, we are developing these processes, and right now the deposits are pushing around 60 million, but we anticipate that these kind of deposits, which by the way are very sticky because they're consumer funds that they keep on their wallets or their various gaming apps. And this is going to be true even in cashless gaming at bricks and mortar casinos, which so the ability to grow this business is significant. We see significant deposit growth and sticky deposits because the consumer has bank accounts at Bank of George when they open their app and join their BetMGM or Caesars or FanDuel or DraftKings or any of the others. So we look forward to this to continue to expand and grow as the cashless gaming business grows. And it's going to be a really important source of deposits for us moving forward. Ryan, I'll toss it back to you.
Yeah, that's obviously a key component of our liquidity and core deposit strategy. Just to highlight what Ed said, really, GBank through its partnership through BCS and offering PPA, we're very encouraged, and we see a lot of growth potential within that, because holding those deposits in individual FDIC insured consumer accounts, we believe will transform a lot of how payments are processed within the gaming industry. And obviously, that's an industry that's seen an enormous amount of growth over the last couple of years, and we expect that to continue.
And I think
with that line of,
I know Ryan's going to talk real quickly because we're going to get close on time here. And another really important thing we're launching right now is our credit card. And because credit cards are trying to be used to load these apps and these wallets, and 70% of the time they get denied by the bank that issues the credit card, not because of the user, because it's a gaming code, it's a merchant code that carries risk. Well, we understand that risk. We've been dealing with that risk for 9 years now, and we're launching our own credit card that will be able to be used to load these apps. Ryan, I know I jumped in on you there a minute, but
no, that one's exciting. We have been working long and hard on the gaming friendly Visa signature credit card, which we fully expect to go live with in Q2. And that's just one example of some other ancillary business lines that we're particularly excited about in meeting the needs of a gaming industry that's rapidly expanding geographically and also just by volume. The GBank credit card in partnership with Visa is a critical component of that strategy. We also see strategies in acquiring and also providing additional services to some of these rapidly growing gaming operators. So it's hard to cover all the things that we're working on that are very exciting, that will translate into real success, we believe, for 2023 and beyond. With that, Ed, did you have anything to summarize or conclude before we do have a couple of questions that I can see?
No, I think we have some questions and we're running out of time. I would like to get there. Once again, I think that it's very easy to say, look at all these bank rating companies when they're rating you very well. And we are rated very, very high. CB Resources just rated us number 5 in the country amongst our peers of banks, and we believe that it reflects our strength. And let's go to the questions, Ryan. I see that there's a couple.
Yeah, the first question I'll read is, as rates have ticked up, banks have welcomed the relief on margin pressures. Do you see any downsides for banks if the rate remains high, if the rates remain high? If so, what is the bank doing or how is the bank going to mitigate? So, Ed, do you have any thoughts on that?
Yeah, well, I think so. Yes, I do. From a macro standpoint, since it's such a macro question, when rates remain high, you always question whether or not your borrowers will be able to support those rates. So you watch very carefully your performing assets to see if you start to develop any non-performing assets. And of course, we really, and that depends on how you've underwritten your loans, how you feel about the comfort of your underwriting, the amount of strength your loans have, the ratios that your lenders are maintaining, their income. We watch that carefully. So if there is a risk, there is a credit risk. But we think we've managed that very carefully by our initial underwriting, where we know that there's strength and backup to the loans and strong guarantees behind the loans. So I think from a standpoint of the rates staying high, I think you're going to see them stay high for a while. Look, I was doing one of the biggest business deals of my life when prime rate was at 19.5%. I mean, and it was just announced actually that it came down from 19.5%. Those were Jimmy Carter years in 1981. And my loans were at prime minus 10 back then. They were at 11%. But there's always a way, we always find a way to do business. And I think that if they remain substantively higher than they've been, most people are used to very, very low rates because they've been in existence for 5-6 years now. But many of us are not. We understand what the more normal borrowing rates are. And so in trying to perform our underwriting based on the fact that they may go up, I think has served us well. So banks have to watch that side of it. Ryan?
Yeah, I agree. I think one of the first things that we watch is credit quality. We have less than 1% non-performing to total assets at year end, actually well below 1%. We're very closely connected to those portfolios and those borrowers. We're communicating with them directly. I think there's other pressures that will continue. I think the investment pressures, the securities pressures will continue with the industry. We talked about that. And I think that it really challenged the notion. A lot of banks went into this with the assertion that they were highly asset sensitive. And I think that some of that notion has been challenged recently with some of the liquidity and deposit challenges they have, which we think actually presents an opportunity for us. As mentioned, our deposits are up year to date. And an interesting thing that we're seeing just even in the last few weeks that I'll note is we're seeing some build within our conventional local lending pipelines as some of the other banks have started to tighten up on the credit side.
Right. I saw the other question, Ryan, with our primary drivers, and I'll start it, let you finish it as you always do so well. But here we talked about our gaming division, our credit card division, and our commercial loan division, and our SBA division. Those are our primary drivers. And you notice I mentioned 4 of them. We never hook our horses up to one wagon. We always want to make sure we're diversified. But we also believe in this payments world that our gaming driver is going to be really significant for us. There are gaming companies with billions and billions on deposits that just are sitting in banks. It's consumer money. We have a home for some of those funds, and we believe that that's going to be an important driver. Our SBA division is critical to our non-interest income. And then, of course, our good loan portfolio and our interest income. Ryan.
Yeah, I think that those are the key drivers. With continued growth in our regional gaming fintech, we're really excited about our ability to continue to grow our core funding and core deposit model. And then on the asset generation side, government guaranteed SBA lending, we're actually having conversations with gaming operators about financing and credit on that side as well. So that coupled with credit card are areas of asset generation that we're particularly excited about.
Yeah, it's interesting because in our credit card side, if we build our credit card business up to 50, 100,000 cards, we're going to be a significant credit card player. And we have opened up almost 1 million accounts in the gaming consumer industry already. About 500,000 active right now today. And those are our primary markets for our credit card too, because we know they participate in these and their gaming apps. And we know this credit card will be a valuable tool for transferring funds to those apps.
Okay. Well, thank you, everyone. We're pleased to join on the virtual conference today, and I think we've run out of time. The slide deck in entirety will be posted via the OTC virtual website, and we'll also be posting it on our OTCQX site as well. So happy to have follow-up and questions with everybody on the line.
And just in closing, one of the things I didn't mention is our executive management team. You know, I mentioned our board, but you look at that deck, and we have a new COO coming on board. Ryan hired, and I hired a new CTO last year. We have just got an exemplary executive management team that I would put against anyone, anywhere, anytime. It starts with that other man on the screen right there. He's quite remarkable.